You mentioned commodities, and the Bloomberg Commodity Index is pressing up against its 3-year average. And I want to know from you, how significant is it on a monthly close above 106? And what asset classes do you expect have the most impact if commodities finally actually start rallying?
Last time around, it was energy in that late 2020 to early 2022 move where the Bloomberg doubled in a year and a half. Energy tended to be at the front end of that, oil prices, in terms of percent gain. Grains had a pretty good move, but I'm not so sure it's going to be energy leading this time. I think energy will be dramatic because we have a very clear, not a price level, but a momentum structural breakout that will occur if you close any month during this quarter at $70. Next quarter, it'll adjust down a bit. We're a few dollars below there right now, like pushing at it. You slip out and close over that average, which happens to be the 3-quarter moving average of oil. There's a structure there, meaning when you plot an oscillator momentum chart of crude oil, you would see a trend line that you can't believe, precision of it. When you look at a price chart, you cannot see that structure. In other words, getting over 70 doesn't mean much when you look at a price chart. From momentum, it smacks you in the face. It says, I'm coming out of here. That will probably be very coincident with Bloomberg getting up over 106.50 on a monthly close anytime this year. Annual momentum of Bloomberg is positive, but in the recent pullback, it slipped back below its 3-year average, which in and of itself wasn't structurally important. It's just you cross below the average. Sometimes that's not important. It's the structure on the oscillator. But over the last 2 years, there have been multiple rallies by the Bloomberg, each like 4 or 5 rallies, that each time they get up to 106.50 to 108 in price, there's a ceiling, and they can't close a month over the 3-year moving average. It's a structure. In other words, if you looked at it, you'd see a structure you can't see so well on price. You close over that number, it's saying, I'm up out of the base. I'm breaking out of my base. I'm reasserting the ongoing trend, which commenced in October 2020. This is the next wave. And I think this time the Bloomberg will be in sync but lag to gold. Like I said, commodities don't always move with gold. There are a couple periods in time they have. Stagflation in the late 70s. Stock market was a wasteland. Commodities exploded on the tail end of gold, which was already exploded. Then again in 2006, 7, and 8, commodities exploded along with gold, and so forth. So I think they're about to get back in sync so that when you look at the horizon of categories and say, where was the best place to put my money? Well, there's a slightly awakening investor crowd in the U.S. that's finally realizing maybe gold. I think Europeans and Asians have long known this, but the Americans, for some reason, are lagged to that. They're very underinvested in gold and gold related. Gold has been the ongoing place to be, but suddenly you'll look at commodities and say, what's going on here? I thought Trump was going to keep it under control, and it would ambush people intellectually and emotionally if that category started to turn up for no particular reason other than, of course, it's cheap historically, and the money flow from the central banks goes somewhere. And investors finally say, hey, I think I'm going to put it in commodities. They're cheap. But also look at commodity stocks. That's a great place to be. Agricultural related, energy related, but wait for the Bloomberg breakout, and we time that, and wait for the crude oil breakout. And they're literally just a few percent above where they're trading right now. And I don't think they need a headline to break out. They'll do it on their own with no particular reason. Then you'll start to gush, and then maybe some headlines will occur. But I think that's a place to put money right now. If you're gold, silver primarily, secondarily, commodity assets.
You wrote also that the commodity spike would also destabilize public sentiment and erode the confidence in both political parties. Well, what do you mean by that?
Well, I mean, the Democrats went through a crisis in the last election, and they're still trying to pick up the pieces, and the party's broken. In fact, there's a far left that's trying to reassert itself like it never has before. The guy running for mayor and so forth wants to, it's fragmented badly, intellectually, organizationally, so that party's sort of crippled now. It's almost as if we're going to head for a multi-party system, like in Europe or Asia. Where it's not 2 parties anymore, it's 5. Okay, they make coalitions, which would upset a lot of people in terms of a notion of stability. And again, that's emotional because when you have a lack of stability, a lack of predictability, an inability to understand why is this happening, like oil going up now, or in this case, political. Well, if Trump loses on that primary issue of keeping the average guy's consumer prices low, particularly gasoline prices, that hurts quite a bit because when you pump it, you see the numbers clicking. You know what I mean? It's sort of emotional. If all of a sudden gasoline prices go up by a buck 50, the average guy's going to say, well, I thought this party was going to stabilize things. My life is worse than it was before. Who's in charge? So you get, again, this sense of uncertainty that brings emotion. And when you get that element added to the mix, emotion, particularly on both sides now, it's like 52 card pickup. Where are we going? What's going to happen? Okay. And that will, you can imagine the impact that will have on given markets and things that we consider normal expectations. For example, I would throw out these assumptions, and I bet I'll be right. Question is when. I bet there won't be a Federal Reserve in a couple of years. Not so much because the Trump or some of the House Republicans don't want a central bank, but because generally they'll be perceived as a non-functional agency in the sense that you go back to history of the Fed and you'll see boom-bust cycles. Monetary boom-busts, followed shortly by stock boom-busts. And even non-ideological economists will look at it and say, it really hasn't been working well. They're always too late or they're too early or whatever. So that could be an entity that's gone, something we think is permanent.
When you look at markets today, the word that keeps coming back to me is fragility. We've built a global financial system on the assumption that debt is infinite, that confidence can be managed with a press conference, and that inflation can be dialed up and down like a thermostat. And yet here we are, with central banks holding interest rates at levels they swore they'd never tolerate, fiscal deficits exploding, and currencies being quietly abandoned in favor of real assets. It feels a little bit like standing on a frozen lake in March. You can still walk on it, but every step echoes, and you know it won't hold much longer. I want to start with gold, because it's the linchpin of everything. Gold isn't just another commodity, it's the benchmark of trust in the system. Every time the Fed promises to tame inflation without pain or assures us that the US economy is strong, investors smile politely and check what gold is doing. And what it's doing right now is telling us the narrative is collapsing. The breakout we've seen in recent months is not just another upleg, it's a structural shift. Momentum indicators, which are the backbone of my analysis, are showing that gold has broken through resistance points it hasn't touched in decades. That means this isn't a false start. This is the beginning of a repricing. A lot of people ask me, Michael, hasn't gold already run too far? And I always respond with context. Adjust gold for real inflation, not the CPI numbers cooked in Washington, but real-world cost of living. If you use the kind of metrics that shadow stats and independent economists calculate, gold would need to trade above $5,000 just to match its inflation-adjusted peak from 1980. And silver, even more distorted. Its inflation-adjusted peak would be over $200 per ounce. So when someone tells you that gold at $2,500 or silver at $30 is expensive, they're not looking at history. They're looking at the rearview mirror of the last 10 years, not the long sweep of monetary debasement. This is important because history doesn't just rhyme, it repeats with variation. Think back to the late 1970s. Stocks were a wasteland. Bonds were toxic. Inflation was eating savings alive. The only assets that preserved wealth were real assets: gold, oil, farmland. We are back in that setup. The only difference is that the scale is bigger, the debts are larger, and the political class is even less prepared to handle the fallout. Now let's talk about commodities more broadly, because that's where the story widens. The Bloomberg Commodity Index has been pressing up against its 3-year moving average. On the surface, that might not sound like much, but when you dig into momentum charts, you see a structure that is screaming breakout. Price charts alone don't show you this. It's the oscillator, the momentum line, that makes it undeniable. The Bloomberg Index has been capped around 106 to 108 on repeated rallies. Each time it hit the ceiling and failed to close above that level. But if it finally does, if we close a month above 106.50, it's saying the base is broken, the trend is resuming, the next wave of commodities is here. And here's where it gets interesting. Last time we had this kind of setup, around late 2020, it was energy leading the charge. Oil doubled in a year and a half. Grains surged. That rally was dramatic, but I don't think this time it will be energy leading. Don't get me wrong, oil will have its moment. The structural breakout in crude oil is incredibly clear. Close a month at $70 and momentum says we're out of the base. But this time, I think the surprise will come from the broader commodity complex. Agriculture, metals, maybe even softs like sugar or coffee. Why does this matter for gold investors? Because when commodities move in sync with gold, you get the stagflation dynamic. That's when investors are trapped. Stocks can't help them because rising input costs crush margins. Bonds can't help them because inflation eats the yield. The only refuge is real assets. And once again, it will ambush people emotionally. Investors in the US, especially, are woefully underweight gold. Europeans and Asians understand it better. They've been accumulating for years. But the average American investor still thinks of gold as a barbarous relic. That's going to change. And when it does, the flows will be massive.
Jamie Dimon of JP Morgan, he's been saying, this crisis has been sort of avoided and ignored, the debt crisis, U.S. government debt. But this time it's probably not going to be washed away, that it's going to have consequences. In other words, real world consequences, not just chatter about, oh my, the debt ratio is wrong. When that happens, the central bank is the chief firefighter. Has to be. It comes in to save the government debt, which saves the government. It has to. So central government policy and central bank policy here and elsewhere, no doubt, will have to shift to more monetary excess once again, even more than they've done regularly. There's always monetary excess, growth in the money supply, artificially low price of money, interest rates. But when this kind of accident lands in their lap, that's when they have to do something fairly dramatic because it's a huge time bomb. It's not a little one. And that creates further monetary distortion. What drives gold? The ongoing decay in the money units, the real value. And that will be a facilitator to more or less fuel inject the gold uptrend, a more vertical manner. So that's why we tell our subscribers, don't just look at gold, look at the stock market, look at the bond market, look at the dollar, which is now, and by our metrics, we turn bearish at 104, it's trading at 98 right now, US dollar index. That's one piece of fiat versus others. It's not real value, it's just relative. All those things are indicating further fuel for gold because the governments will have to panic. Now, Powell has played this game, poker, saying, everything looks pretty good on the economic side. Well, today they just got a number that didn't look so. And really inside the job market numbers, they don't look good because it's mostly government growth. Last job report was like 50% of the growth was state and local government, essential to the commodity, to the economy, right? Anyway, those data points will go fast to the south and he'll have to change his mind. And already he has two, and probably 3 or 4 ready to come on board who want to cut rates now. And he's resisting them as well. Well, suddenly he's going to have to decide, does he want to go down in history as somebody who was fighting the president and even members of the Fed and was lagged to reality, or is he going to finally get in tune and anticipate, which they're supposed to do, upcoming changes? And I think when they shift, especially when the stock market starts to break and create discomfort, emotion, the bond market remains at high yields, doesn't even have to go higher. But if it did go lower, I think it could be a mini panic. There's certain levels on T-bonds, you mentioned TLT, that if we drop below, and it's several points below TLT, that's all, it could precipitate a puke, a sharp, rapid, instead of an erosional weakness, a sharp panic. Now, undoubtedly the government will take military-type steps to defend against that. So I don't know that the panic would last, but it would cause the government to be provoked, not incrementally, but, all of a sudden in this new direction, central bank. And that is what will fuel inject gold. And I think all these things combined are essentially merely further fuel for the monetary metals waiting when they occur to cause acceleration in what's already going on.
We've lately seen a renewal of concerns about the JGBs and the fact that they might be also a threat to the unwinding of already pre-existing unwinding of the yen carry trade. I've had a great conversation about this with Francis Hunt a couple of weeks ago. What is your take on that? Is this the Achilles heel?
We've not looked at the JGB. I know it's in a similar crisis mode, and I know the Japanese certainly have earned it. Okay, they invented QEs. Okay. And finally it's coming home to bite.
When you step back and look at the whole landscape, it becomes clear that this isn't just about gold or even commodities. It's about the unraveling of confidence in the structure that has held up the global economy for the last 80 years. Let's start with bonds because that's the foundation. For decades, U.S. Treasuries were considered the risk-free asset, the anchor of global finance. Central banks held them as reserves, pensions loaded up on them, and Wall Street built an entire derivatives empire on top of them. But what happens when the so-called risk-free asset starts losing people money year after year? We've just gone through one of the worst bond bear markets in history. Yields surged from near zero to levels not seen since before the financial crisis. Anyone who bought treasuries in the last few years has taken a bath. That is not supposed to happen. Bonds are supposed to be boring, stable, the thing you own when you don't want surprises. Instead, they become a source of pain. And that pain isn't just financial, it's psychological. Because if treasuries can't be trusted, then what can? Now here's the kicker. The government can't afford these yields. The U.S. debt to GDP ratio is north of 120%. Interest expense is already one of the largest line items in the budget, larger than defense, larger than Medicare. Every uptick in yields makes that worse. So what's the solution? More issuance, more debt, more borrowing to pay the interest on the old borrowing. It's a debt trap and the jaws are closing. In momentum terms, bonds are not signaling relief. Yes, you get rallies. Yes, yields dip occasionally, but structurally the momentum charts show a breakdown that is historic. That means rallies are not recoveries. They're pauses in a secular bear market. If you think back to the 1970s, you'll remember that bonds were called certificates of confiscation. That's where we're headed again. Only this time, the scale is exponentially larger. And that brings us back to gold and silver. Because when the so-called safe assets are unsafe, people look for alternatives. Silver, in particular, is fascinating here. It's not just a monetary metal, it's an industrial one. And the industrial demand story is explosive. Solar panels, electric vehicles, electronics, all of them need silver. The Silver Institute projects demand to hit record levels, while supply is stagnating. That's a recipe for a squeeze. And here's the thing about silver. It doesn't move in a straight line. It lulls you to sleep, chops sideways, and then suddenly jumps 30% in a few weeks. That's not speculation. That's its DNA. If you look at momentum, silver is coiling. It's been suppressed, capped under resistance. But that kind of coiling doesn't last forever. When it breaks violently. And when it does, it won't just be retail investors piling in. Industrial users who have been lulled into complacency by years of cheap silver will suddenly realize they need to secure supply. That's when you get the panic bid. That's when you get $50 silver again. And this time, it won't be a spike that collapses. It will be a repricing. Let me share something I read recently. A Bloomberg headline: U.S. Mint runs out of silver coins amid surging demand. That's not 1979. That's now. It's a reminder that the physical market is tight. Dealers are reporting premiums that sometimes exceed 50% of spot. That's not normal. That's stress in the system. And if you think that's just a quirk, think again. When physical demand and paper supply diverge too far, paper loses. Always. Now, I know some of you are thinking, Michael, you're sounding a bit like a doom prophet. But this isn't doom for the sake of doom. It's simply the recognition that cycles end. Systems age. Confidence erodes. The Fed, for example, was once seen as omnipotent. Whatever they said, markets moved. Now, every time Powell speaks, markets rally for 5 minutes and then roll over. That's not control. That's exhaustion. Let's be blunt. The Federal Reserve has become a non-functional agency. It's trapped in a cycle of creating booms and busts, always too late or too early, never getting it right. Even non-ideological economists, people who don't care about Austrian or Keynesian debates, are starting to say it doesn't work. And if commodities break out, if inflation returns with a vengeance, the Fed will be exposed once again as powerless. That's when you start to see calls for structural change. Maybe a new system, maybe a diminished role for the Fed, maybe something like what the BRICS are trying to build, a system anchored in real assets, not just promises. And let's talk politics, because you can't separate markets from politics anymore. Commodities surging will destabilize sentiment. Democrats are already fractured. Republicans are fractured. You could even see the U.S. drift toward a multi-party system, more like Europe. coalitions instead of majorities. That might sound abstract, but it means instability. It means gridlock. And markets hate that. Investors crave predictability. If they don't have it, they demand a higher risk premium. That means lower valuations for stocks, higher yields for bonds, and more flows into gold. Now here's the irony. Every time the US tries to project strength by sanctioning another country, by weaponizing the dollar, it accelerates the very trend it fears. Countries don't want to be at the mercy of a financial system that can be used against them. So they build alternatives. They buy gold. They cut deals in yuan, in rubles, in rupees. The dollar doesn't collapse overnight, it erodes. And that erosion is already happening. Let me add a bit of humor here. Someone joked on Twitter, "The Fed's balance sheet is like my diet plan, always expanding, never shrinking." And that's true. They talk about balance sheet reduction, about quantitative tightening, but look at the numbers. It never lasts. Something breaks, they reverse course, and the balance sheet balloons again. That's not policy, that's panic management. So where does this leave us as investors? In a world where bonds can't be trusted, stocks are overvalued, and fiat is being debased, the answer is simple. Real assets. Gold, silver, commodities, farmland, energy. Things you can touch. Things that don't go to zero when a central bank makes a mistake. But let me stress this. Timing matters. Momentum matters. Don't wait for CNBC to tell you commodities are back. By then, it's too late. Watch the signals. Watch the breakout levels. 106.50 on the Bloomberg Index, $70 on crude. When those break, it's not a debate, it's a signal. And those signals are flashing. To wrap this up, let me give you a vision of what the next few years could look like. Gold surges past $3,000, then $4,000. Not in a straight line, but in steps. Silver breaks $50 and doesn't look back. Commodities, led by agriculture and industrial metals, explode higher. Bonds remain in a secular bear market. Stocks chop sideways at best, down hard at worst. The Fed loses credibility, maybe even its central role. The dollar weakens, not in a crash, but in a steady bleed. And through it all, the investors who saw the momentum early, who positioned in real assets, will not just preserve wealth, they'll multiply it. Because at the end of the day, this isn't just about charts or momentum or cycles. It's about trust. Trust in governments, trust in central banks, trust in paper promises. And that trust is evaporating. When it's gone, the only things left standing will be the assets that don't depend on trust, only on reality. And so I'll leave you with this. Don't wait for permission. Don't wait for consensus. The signals are there, the structures are clear, and the opportunities are enormous. Position accordingly, and when the tide shifts, as it always does, you'll be on the right side of history.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.